Welcome to the Captain's Blog. I'm David McDonough, Senior Vice President and founder of Flagship Wealth, powered by Trilogy. On this blog, we try to take what's unnecessarily complicated out there on Wall Street and sometimes DC and make it understandable to you on Main Street. Market recovered 4.5% last week, up 14% from the low that we saw just 3 short weeks ago. What happened? Well, it was all quiet on the tweet front, negotiations happening behind the scenes, and also fundamentals, earnings. Corporations are reporting good earnings. Again, that's why you invest in the market for growth. Did that positivity continue this week, or did the tweets come out? Here's your week in review. So to answer that question, the answer is yes. The market up an additional 1.5% for the week. And get this, only down 0.75 for the month of April, where I just told you at one point it was down 11%. What carried the momentum this week? Well, it wasn't the GDP, gross domestic product, which measures our economic growth. It went into negative territory. And remember, 2 quarters of negative growth equals a recession. Well, I believe that this was manufactured, and that next quarter we will see growth again. But in the middle of the week, consumer confidence was reported. Negative, one of the worst prints in years. Again, I believe that that is looking in the rear view. Of course you're out there not confident as to what's going on in the economy, what's going on in the market. It makes sense that you're not confident. What I am confident about is this. Companies like Microsoft and Meta came out with solid earnings and solid growth. Corporations are still making product. They're still manufacturing. They may be in a pause, waiting for the next tweet, but again, still in positive territory. Now, here's what to look for next week. So next week is a big week for reporting earnings for corporations. Expect good earnings from the previous quarter, but the majority of firms out there, when they project what they're going to do, it's obviously a bit foggy. We also have the Fed meeting next week, where we believe that they will not cut rates, but indicate that they will moving forward. And that's positive for you out there where it comes to spending in the economy. Again, credit card rates go down. Home equity lines go down. You're more confident to invest. And lastly, I believe that there will be some positive news coming out of China. But at this point, I believe we're also at the top end of the range where it comes to the market. So be prepared for more volatility. Here's your personal finance tip of the week. It is time in the market, not timing the market. Again, as I just mentioned, the market at one point was down 14% for the month. Has anything changed fundamentally? The answer is no. But this is what's going on in Main Street. In the middle of February, at the market at an all-time high, everybody wanted to buy that AI company that they can't pronounce. And it was $150. Well, it hit 100 last week, and nobody wanted to buy it out there on Main Street. They wanted to buy gold at an all-time high. Well, that AI stock has recovered nicely. Gold is down 7 or 8% in just a week. Do not chase. Repeat after me. Whack-a-mole. For those of you out there that have Captain's Blog bingo, you just yelled it. The market is going to make you look silly if you try to time it. Stay diversified, proper asset allocation, and you'll do better in the long term. So thanks again for checking in. We'll see you next week on the Captain's Blog.